Welcome, everyone. My name is Sandy Blair, and I'm the director of the CalSTRS Pension2 program. And I'd like to thank you for attending our webinar today. I would like to introduce our consultant, Scott Downhauer. He is the principal and owner of Meridian Wealth Management and Meridian Fiduciary Consulting. Scott is a certified financial planner and has been serving school employees since 1997. Scott has spoken nationally on retirement issues for those in education and lobbied for better consumer protections in California. He has his bachelor's degree and a master's degree in financial planning and has worked in the financial services industry for more than 20 years. He is also the co-author of the 403B Wise and an upcoming book, The Fiduciary Advisory's Guide to Working with Public School Employees. So Scott, I would like to thank you for being here for this Ask Me Anything session. And I'm going to turn it over to Oscar, who will be the moderator of our webinar today.
Thank you, Sandy. My name is Oscar Aguirre, and I work for CalSTRS. So we're going to follow this format for this webinar. Go ahead and use the chat box on the right to ask any questions. As we receive your questions, we'll address them, and Scott will answer those questions as they're coming in. What I'm going to do now is ask Scott to kind of give us a background of 403Bs and 457s in California right now, and give you guys a chance to type in your questions so we can start getting the webinar started. Scott?
Great, thanks Oscar, thanks Sandy. Appreciate you asking me to be on here today. Excited to be here. So Oscar asked me to give a quick kind of state of the 403B market in California while people are typing in their questions. So I'll go ahead and just kind of give you a brief overview. In my opinion, the 403B market in California is actually still a bit of a mess. 403B plans throughout the state are littered with lousy investment options. Public school employees are misled about what's best for them by people who are selling products for commissions. And there's little in the way of objective information or really objective education being provided. So it leads to a lot of confusion when it comes to 403B plans, 457 plans. And we'd like to see that changed. Right now, there's very little or no oversight of these programs, but CalSTRS is slowly changing that. While I wait for a few questions here, the CalSTRS actually offers a 403B plan. Some of you may have heard it referred to as a TSA. We'd like to call it a 403B because we think that's a better descriptor of it. It's just simply a defined contribution program where you can put money into an account that grows on a tax-deferred basis or a tax-free basis. The money comes out of your paycheck, and it comes out of your paycheck on a pre-tax basis or an after-tax basis, depending on what you've chosen. And they are great accounts to help supplement the defined benefit that you receive from CalSTRS. And since 403Bs and 457s are the main topic of discussion today, I think we're going to start out by taking some questions on those.
All right, Scott, you ready?
Yeah.
The first question we got, it looks like, should I potentially use my 403B for my son's college fund if I already have a Roth IRA and a pension when I retire?
Interesting question. I actually get this question quite often. I generally advise against it. Whenever you take money out of a 403B, for the most part right now, most money in 403B plans are pre-tax, which means that you deferred money into this plan and essentially received an upfront tax deduction. So when you pull money out of it, that money is going to be taxable income. It's going to be taxed as ordinary income, both and the federal level. If you're over age 59 and a half, there won't be any penalties for taking that money out, at least federal penalties. So you won't have to deal with that. But the problem is taking that money out is probably going to put you into a higher tax bracket. And so you're going to have to do a distribution to cover college, as well as an extra distribution to cover the taxes for the first distribution. So it's really not a great place to save for college expenses. Actually, the person asking the question had mentioned their Roth IRA. Roth IRA is actually not a bad vehicle to save for college expenses. There's a few caveats there. But most people, if you're looking for a tax-free option for saving for college, I usually would consider what's called the 529 plan. And that's simply a program where you put money in, you don't get a tax deduction, but the money grows on a tax-free basis if it's used for education. So it works kind of similar to a Roth account. But I would generally avoid using 403Bs for college expenses.
Thank you, Scott. It looks like we had some more attendees pop on, so I'm just going to repeat that if you have any questions, go ahead and enter them in the chat box, and then I'll read them out to Scott, and he'll address them as we're going down the list. So the next question for you, Scott, are there any differences between a 403B and a 457 other than an early withdrawal penalty?
Okay, this is actually a little bit longer question to answer. Most people today don't know that they likely have access to two different defined contribution programs through their employer. One's called a 403B, one's called a 457. About a decade ago, most educators only had access to a 403B, but there was a change in the law that allowed for this other account called a 457. And the 457 works very similar to the 403B. You can make contributions on a pre-tax basis, and it'll grow tax deferred for retirement, or you can make contributions on an after-tax basis, and the money grows tax-free. Those are called Roth options. But there are a few differences between these two accounts. You can contribute to both up to the 2015 limits. But there's a few differences that you need to know about because one of these accounts might actually be better for you than the other. So as was mentioned, with the 457, there's no 10% federal early withdrawal penalty if you take your money out before age 59 and a half. There is such a penalty in a 403B. As a side note, you didn't ask, but in a 403B, you can get your money out prior to 59 and a half without that 10% penalty, but only if you retire in the year that you turn age 55 or later. Otherwise, the 403B is going to have that 10% penalty. But in the 457, as long as you have separated from service from your employer, that money is always going to be available to you without having to pay a 10% early withdrawal penalty. You still may have surrender charges from the vendor that you're using, but there's not going to be any federal tax penalties. Also, most plans will allow you to distribute money from your 403B once you hit 59 and a half, regardless of if you're employed or not. Not so with the 457. With the 457, if you're still employed, you're not going to be able to take a distribution at all. There's an exception for certain emergencies and loans, but in terms of just getting access to your money, you actually have to be separated from service to do that. Another difference is that 457s allow for more investment types than does the 403B. 403B is limited to an annuity account or a custodial account that holds mutual funds, whereas a 457 actually doesn't have any restrictions or has very little restrictions on what you can hold in a 457. With that said, most 457s limit you to mutual funds and annuities, but they're not required to do that. Another big difference, and something that you should definitely consider when choosing between the two, is that the 457 has a different catch-up option than does the 403B. Both of them offer the age 50 catch-up, meaning that if you are age 50 or older, you can contribute an extra amount to your 403B or your 457. However, the 457 has this kind of interesting feature that allows you to double your contributions in the 3 years prior to the year that you retire. And each plan has a little bit different definition of how that, what they call the 3-year catch-up option works. So you'd want to check with it. But you can literally double your contributions. So if the contribution level was $18,500, you could actually double your contributions for that year and contribute up to $37,000. That's a pretty high contribution limit. Not everybody can do that. The one caveat is, well, actually 2 caveats. One, the plan doesn't have to offer that as an option, so you'd have to check to see if it's available. And 2, you actually have to have eligibility to use that option. And what that means is there must have been years in the past that you could have contributed to the 457 but didn't. After all, it is called a catch-up, so you're catching up on contributions that you could have made in the past but you failed to do. So there's a few caveats, and you'll want to check with your individual plan with your employer to see if they apply. The other thing with 457s that's different than 403Bs is that they don't have a separate limit for employer contributions. In a 403B, if your employer wants to make contributions to your plan, they can do so, and you can still make contributions up to the limit for that year. Not so with the 457. With the 457, if an employer makes a contribution to your account, that lowers the amount that you can contribute to that account as well. And then finally, most of you probably won't care about this technicality, but there is a rule that when you start contributions into a 457, the salary reduction agreement must actually be in place the month prior to the month in which contributions are deducted from your paycheck. And all that really means is if you want to make contributions in November, your salary reduction contribution has got to be in before the end of October. That's all that really means. There's a few other technical differences that we don't need to get into, but overall, those are the main differences between a 403B and a 457.
Okay, thanks, Scott. The next question we have is it worth it to use my money from my current 403B to pay some of my credit card debt?
Well, I guess my answer to that is it depends. Normally, I would not encourage people to take a distribution from their 403B. In fact, I would almost always counsel against taking a distribution from their 403B to pay off credit card debt. The main reason being that, like I said earlier about the college distributions, if you take money out to do that, that money is going to be taxed as ordinary income and potentially subject to federal penalties and perhaps even state penalties. And you end up with about 35 to 40% of the amount actually going to taxes. And that doesn't do you any good. With that said, and by the way, you also wouldn't be able to do it because there's only a few reasons that you can actually take money out of a 403B as an actual distribution. So you really wouldn't be able to do that unless you were over age 59 and a half or you had separated from service from your employer. But there is another way, and this might actually be a good option for some people. As you know, there are credit cards don't always sport the lowest of rates. If the interest rate on your credit card is high enough, you might want to consider taking a loan from your 403B. Now, I don't really love to advise people to take loans from their 403B. However, there is the possibility that it could be a wise decision. If your 403B is not earning a high rate of interest, and you're paying a high rate of interest on a credit card, that's a pretty good opportunity to pay off some debt that's at a high interest rate while taking the money from an account that is not paying you a very good interest rate. So If your credit card debt's at 16% and your 403B is paying you 2%, it's not a bad idea to consider taking a loan. You should probably look at some other options as well. Another thing you could consider is stop making contributions to that 403B and redirect that money to that credit card to pay that off. So it kind of depends on the individual, depends on the credit card interest rate, depends on the rate that you're receiving on a loan. In general, I'd say don't do it. I would especially say don't do it if you actually have to take a taxable distribution. But if the loan terms are reasonable and the interest rate on your credit cards are high enough, it is something I would consider.
Thank you, Scott. It looks like we had some more people jump on, so I'm going to repeat this again, that if you do have a question for Scott, go ahead and use the chat box on the right, submit it, and when Scott has a chance, I'll read it to him and he'll answer the question for you. Okay, so it looks like the next question, if my employer goes bankrupt, will I lose my 403B if I'm vested?
All right, well, the quick answer is no. Once your money reaches a 403B account, and also, by the way, a 457 account, it is completely separate from the plan sponsor, from your employer. The employer cannot use those assets to pay their own bills. Now, if you have deferred money out of your paycheck and the employer has not sent that money yet to your 403B, it's still in your employer's possession, so usually it's just like, say, 1 month of contributions, then that's a possibility. You have the possibility that you could lose that specific contribution. But the money that's already in your 403B, the money that's already in your 457, you can't lose to creditors of your employer. It didn't used to be that way with the 457. Prior to the Small Business Jobs Protection Act of, I think it was 1997, you could actually, the assets in a 457 plan were subject to the creditors of your employer. But after what happened in Orange County that year, there was a federal law passed that essentially protects that account as well. And you didn't ask it, but your 403B and 457 are also typically protected in the event of a bankruptcy, a personal bankruptcy as well.
That's good information, Scott. Looks like our next question here. I am a teacher and I have a 403B. I realize now that this is not a great account. Should I keep contributing to it or stop putting money in it and put that monthly amount into something else?
So I'm going to assume that the questioner means the particular 403B that they have is not a great account. Perhaps it's a high-cost variable annuity. Perhaps it's a fixed annuity that has surrender charges and a long surrender period, basically meaning if they move providers that they'll end up paying some big fees. But not that they're talking about a 403B. A 403B in and of itself is neither good nor bad. It really depends on the product that you have and the vendor that you're with. So I would say, yeah, stop contributing to that particular 403B. But don't stop contributing to a 403B in general. Continue to contribute to a 403B or a 457. Just move your money and move the contributions to a different 403B. As I mentioned earlier, CalSTRS has a great account. It's called Pension2. It's available in most school districts. And there's a couple other good providers here in California as well. So I wouldn't give up on the 403B. You may want to give up on that particular 403B account. One kind of addendum to that, I'm not sure why you think that the 403B you have is not a great account. The reasonings there may make me give you different advice, but if it's not a good 403B because it's perhaps a fixed annuity sold by an insurance company that pays high commissions and it has surrender charges or surrender periods, you should do some additional research. And if you've owned that for a long time, some of the older products that were sold in 403Bs, even though they wouldn't be great to get into now, some of them have some provisions that are actually, we're finding kind of attractive right now. So to give you a quick example, annuities, a lot of these fixed annuities used to have 3% guarantees on them. Nowadays, those guarantees are down to 1% or less. So if you have an annuity with a 3% guarantee on it, probably don't want to get rid of that just yet. So what I would suggest is definitely continue to contribute to your 403B. Just switch to a better 403B. And as I mentioned, CalSTRS Pension2 is a great one.
All right, Scott, it looks like this is a question that we get a lot here at Pension2. It's, is it possible to convert my 403B to a Roth 403B? If so, what are the downsides to making the conversion? Tax-wise, does it make sense for me to convert?
Okay, so that's a tough question to answer without, at least the second part's a tough question to answer without knowing an individual circumstances, but I'll do my best. So the first part of that question, I think, was, is it possible to convert my current 403B to a Roth 403B? And for those who don't know, typically a 403B is going to be pre-tax in nature. So the money comes out of your paycheck on a pre-tax basis, gets deferred into this 403B account, and it grows tax deferred until retirement, at which point when you begin withdrawing, it is that when you take it out, it's taxed as ordinary income. Well, a Roth 403B is basically the opposite. You don't get a tax deduction when you put it in. So the money still comes out of your paycheck, but not on a pre-tax basis. And it grows tax deferred until retirement. The difference being that when you pull the money out in retirement, those Roth assets actually come out tax-free. So you don't have to pay any income tax on them. It's a very nice benefit. So the question is, should you convert your current pre-tax 403B to a Roth 403B, or is it possible? So the answer is yes and no. It is possible to do, or it is legal to do what's called an in-plan Roth conversion. So they are permitted. The issue is that the vast majority of school districts that I've seen their plan documents of do not currently allow for it. So you need to check the plan document to see if the plan document allows for in-plan Roth conversions. Now, that's actually not enough. Because 403Bs in California are multiple vendors, meaning there are many, many different 403B accounts that you can have, you also have to check with the vendor of your 403B to see if they can actually do this transaction. It is not a simple transaction, and many 403B vendors still have not coded to be able to do it. And so, first of all, it has to be available as an option. Second of all, your vendor has to be able to do it in order for you to even look at whether or not you can do a conversion. So that brings up the next question. If you could do it, what are the downsides to making the conversion? And in that part, it really depends on your tax bracket, what you think your tax bracket's going to be now and what it's going to be later. If you're going to be in a higher tax bracket later on in life when you're going to pull this money out, it might make sense to make that conversion. If you're going to be in the same tax bracket, there's got to be some other reasons for you to make that conversion. If you're going to be in a lower tax bracket, it doesn't really make sense because you would be pulling money out, paying taxes on it, and then you would be pulling that money out again in retirement at a higher tax rate. It just wouldn't really make sense. So you want to make sure that your tax bracket is at least going to be higher when you pull that money out than it is right now. The other downside to an in-plan Roth conversion is that you're going to need to pay the taxes that are owed from a separate source. Just because you do an in-plan conversion does not mean that they can distribute funds to you, or that they can pay the taxes owed through that conversion process. You have to have a stash of money outside of your 403B to be able to make the taxes that are owed to both the state and the federal, the state and the feds. Otherwise, you could find yourself with a big tax bill and no money to pay for it. So hopefully that answers your question. I haven't seen a lot of these available, but I do hope to see it available in the future.
Perfect. Thanks, Scott. Let's see. The next question we have, it says, I know that RMD is required in the year that I turn 70 and a half, and that it applies to my traditional IRA. I also have a 403B account with my employer. Does RMD also apply to my 403B account?
Thanks for the question, Marty. A required distribution has to occur for both the IRA and the 403B. And so probably most people don't know what a required minimum distribution is, or as we like to call it, an RMD. When you turn 70, technically 70 and a half, you have to start taking money out of IRA accounts, 403B accounts, and 457 accounts. The reason for that is the IRS has given you a tax benefit, but they really want you to pull that money out so you pay taxes on it and help the Treasury. They never intended for these accounts to be life savings accounts. They want you to take the money out. So they institute this rule called required minimum distribution. And a required distribution must occur by April 1st of the year following the year in which you turn age 70 and a half. And I think the main part of the question is, can I just aggregate my IRAs and my 403Bs together, use the required distribution formula, and take a distribution from one of my IRAs? Well, this sounds like something that would be reasonable that you should be able to do. The IRS doesn't allow it. You can aggregate all of your IRAs and take a single distribution from one of them, and you can aggregate all of your 403Bs and take a single distribution from one of them to satisfy the requirements, but you can't aggregate your IRAs and your 403Bs. If you have an IRA and a 403B, you have to take a distribution from each.
Okay, Scott, I have a couple more questions here. It says, my wife was rewarded some money from her previous divorce in the form of an IRA. I have a 403B. Can we combine them anyway?
I wish. I wish the answer was yes. I've actually gotten this question a couple times in the past, and actually even for people who aren't divorced, I get perhaps a spouse has a great option for their retirement account, and the other spouse doesn't, and so they want to combine it and put their money into the good option. But you can't. 403B accounts, IRA accounts, they can only be owned by a single individual person. And because of that, you cannot combine accounts. Now, there is one exception. It's rather inconvenient. So upon a spouse's death, you can do what's called a spousal rollover. So at that point in time, you can take over the IRA of your deceased spouse and roll it into your own IRA or 403B account, but not before.
Okay. The next question is, I have a 403B where my agent provides mutual funds, some the same as in Pension2. My agent has given good service. Can my agent use the funds in Pension2 or set up a 403B for me in Pension2?
Well, I guess it depends on what you mean, can my agent do it for me? It's actually very easy to start a 403B with Pension2, and there are a lot of resources available both online. The staff at CalSTRS and the staff at the Record Keeper can help you or your agent do that. The agent won't get paid for doing that, but they can certainly, I do it for all of my clients, they can certainly download the paperwork, help you fill it out, and then send it in and help you fill out the salary reduction agreement. If that's what you mean by that question, then absolutely. If what's meant, can the agent get paid to sell you Pension2, the answer to that would be no. They would need to figure out their own payment arrangements. I'm not sure if that answered the question, but I think that's what they meant.
Okay. Scott, I think they can re-ask the question if that didn't answer their question.
Okay.
The next one, what happens to my 403B contributions if I should die?
Well, so 403Bs are, basically, you need to have a beneficiary designation on file. And whoever your beneficiary designation is, that's where your 403B money is going to go. A lot of people, they mistakenly think that if they name their IRAs or their 403Bs or 457s in their trust or in their will, that those documents will dictate things. The issue is that they won't. You can make all the elections in your will and trust to tell people where they want where you want your 403 money to go, and it has no legal authority. The only legal authority is that beneficiary designation that you make on your account. So it's a great question, because a lot of people do not have beneficiary designations listed on their 403B or their 457 or even their IRAs. Sometimes they have beneficiary designations listed, but those beneficiaries are not who they wanted to go to. They're old beneficiary designations. I can't tell you how many times I've started to work with somebody and discovered that the beneficiary on their account is their ex-spouse or someone that they no longer want the money to go to. So what happens to your 403B contributions upon death, or your 403B account upon death, will depend on who you have chosen as a beneficiary. If you don't have a beneficiary, it goes to the estate, and that usually has to go through probate.
Okay, Scott, it looks like we're going to take one more question just for the sake of time. What are the pros and cons of taking a loan from my 403B plan?
Okay, well, we went over loans in just a little bit of detail in one of the prior questions. So this is going to depend on the vendor offering the loan. Remember how I said that there's one 403B plan, but many different vendors. Each of the vendors may offer different loan terms. And so it's going to be, you're going to want to make sure that you look at the loan terms with the particular vendor that you have. And if they're not very good, maybe look at other vendors. The pros to a loan are that you can gain access to funds in an emergency, or as we talked about earlier, potentially to pay off high credit card debt. I think those are really the main pros. I mean, when I was working at a call center when I first started in this business, I can't tell you how many loans I did for boats and RVs, and I get it, but I don't think it's really probably the best place to be funding that. So the cons are that you'll be potentially paying interest to a vendor for the privilege of taking out the loan, and you may be paying double taxes on a portion of the interest that you do pay. Because when you take out a loan, depending on the vendor, you're going to be paying interest, and that interest might be is either going to go directly to the vendor, in which case it's gone, or it'll get paid back into your own account. If that interest gets paid back into your own account, that interest is money that you've already paid taxes on, and you're making a deposit into your account. Well, record keepers do not keep track of that as an after-tax contribution. So when that interest gets pulled out at a later date, you end up paying double taxes on it. So you have to be there has to be a good reason to take out that loan. And like I said, there are some good reasons. But in general, if you can avoid taking loans from your 403B, I think that's probably the best route.
Thank you so much, Scott. Thank you for answering all those questions. I want to thank everybody for asking those questions. Um, if you have an additional question or you didn't have the courage to ask your question today, feel free to contact CalSTRS Pension2. We can address any questions going forward in the future for you. We're always here as a resource. So I'd like to thank you all for attending. We do have another webinar tomorrow on building a budget. So at the same time, if you want to register for that, we would appreciate it. And thank you for participating in everything we do for National Retirement Security Week. So thank you, everybody.